Of the question, we are told that differentiate between sensitivity analysis and scenario analysis. So let's write. Can write in our books the difference between sensitivity analysis and scenario analysis. So we say that sensitivity analysis is a risk evaluation technique. Which identifies the key variables which affect profitability. Which identifies the key variables which affect profitability. And then each variable is evaluated at a time. And then each variable is evaluated at a time. And each variable is then evaluated at a time. So let's define what scenario analysis. Scenario analysis, we say that is a risk evaluation technique. It's a risk evaluation technique which uses horizon analysis. To identify the key variables, affecting returns, and then each variable evaluated, to determine their effect on the returns. Good. So we may write another difference between the sensitivity analysis and scenario analysis. We say that sensitivity analysis assumes that variables are independent. While scenario analysis assumes that the variables are dependent. And therefore they evaluated all at once. Good. So that's the difference between the sensitivity analysis and the scenario analysis. So then number B, let's do a question on replacement analysis. And we are told that ABC Limited is contemplating a replacement cycle for the new machinery. This machinery will cost 100 million. So that's the present value of cash outflow to purchase. The operating and maintenance costs for the future years are as follows. So we're given year 0 to year 3. You're given the operating and maintenance cost. Then you're given the resale value of the machinery at the second-hand market are as follows. So in this case, you're given the costs and the resale value. The replacement is by identical machines. Number 2, there are no inflation, tax, or risk, and the cost of capital is 11% required. Advise ABC Limited on whether to replace this new machine in a 1 or 2 or 3 year cycle using equivalent annual cost method. Now, under replacement analysis, we say that when determining the optimal replacement cycle, we say that the optimal replacement cycle is where NPV is maximum. We say that the optimal replacement period is where the NPV is maximum. So in this case, you are given 3 years. It's all about determining between the NPV of year 1, year 2, year 3, which one is the maximum. But in this case, the examiner has specified to use the method which we call the annuity. So under the annual annuity equivalent method. Remember, we said that we have 3 steps which are involved. And step number 1, you need to determine NPV. Determine NPV. Then step number 2, you determine the annuity. You determine the annuity, and you say that how do we get the annuity? To get the annuity, you take NPV, you divide by the present value interest factor of an annuity rate for a given period. And then once you have the annuity, number 3, you determine present value of an annuity until infinity. The present value of an annuity until infinity. And how do we get that? You take the annuity, you divide by R. So now let's evaluate each year. So what if we replace in year 1? How much will be our NPV? And how do we get NPV? So NPV is the present value of cash inflow minus the present value of cash outflow. But in this case, you're not given the inflows, you're only given the costs. So what you'll do, so have our year 0, year 1. Then we get the cash flows. Year 0, that means we're investing. And how much are you investing? The cost of the machinery was 100 million. Then what if you replace in year 1? If you replace in year 1, how much is the resale value? If you replace in year 1, the resale value will get 80 million from the second-hand market, minus how much was the maintenance and operating cost of the machine in year 1. For you to realize 80 at the end of year 1, you have already incurred 120. So how much is our net cash flows? So our net cash flows will be 40. But note that they are both outflows. So you resell it at 80, but you have incurred an operating cost of 120. So those are your cash flows. Then we determine, we discount them. Present value interest factor. The cost of capital is 11% year N. So in year 0, the present value is always 1 because it's already at its present value. So 11% is not in the table. So use the formula 1 plus R raised power negative N. So it's 1.11 raised power negative 1. And here you'll have it's 0.9009. Then we get their present value. This is 100. And then you multiply by 40. Here you have 36. But note that both of them, they are negative. So now we can get our NPV. NPV will be 136, which is a negative. What if now we replace in year 2? If we decide to replace in year 2, you have our period 0, 1, 2. Then we get our cash flows. We get our cash flows. Or before we go to the second step, or to the year 2, we haven't completed the first intake. So in this case, we are saying that under this method, we determine the NPV of which we have the NPV. Then step number 2, determine the annuity. And how do we get the annuity? So to determine the annuity, we are saying that you take the NPV, you divide by the present value interest factor of an annuity. The cost of capital is 11% year N. In this case, it's year 1. So it will be our NPV, which is 136, but a negative. You divide by the present value interest factor of an annuity, 11% for 1 year, which is 0.9009. How much do you get? In this case, you have 150.96, but remember it's negative. Then the third step, you determine the present value of an annuity until infinity. And in this case, you take the annuity over R. Our annuity is 150.96. It's a negative. You divide by R, and our rate in this case was 11%, divided by 0.11. In this case, you have 1372, but a negative. So let's go to second step. The second step in year 2, sorry. What if we replace in year 2? If we replace in year 2, so we have our period 0, 1, 2. Now let's get our cash flows. Year one, we're incurring how much? In short, year zero. In year zero is the year you are investing, and you're investing 100. Then year one, if you replace in year two, that means you have to stay to be with that machine for the 2 years. That means if you stay in the first year, you have to incur the operating and maintenance cost. How much is the operating and maintenance cost in the first year? It's 120. But remember, both of them, the outflows. But now you replace in year two. If you replace in year two, that means in year two, the resale value will be 65. That's the scrap value. Minus, you have already incurred an operating and maintenance cost in year two of 130. So you set it at 65, and then you deduct the cost of 130. So that means in that case, you have a net cash outflow of 65. And then once you get the cash flow, you discount them. Present value, interest factor, 11% year end. So in year zero, the present value is 0. In year one, it's 0.9009. What about in year two? So in year two, just take 1.1 raised power negative 2. You have it's 0.8264. With that, now let's get the present values. So that's 100. Here you have it's 108.108. Here we have 65 multiplied by 0.8264. Here you have 53.716. If you add the total, you get NPV. The total you'll be having is 261.824. But remember, in this case, our NPV is negative. Or alternatively, you can do this. You just get your period year one, year two. You take the cash flows, you will discount them for the 2 years. That's year one, year two. In this case, don't incorporate the year zero. If you add the two, you'll get the present value of cash inflow, which is a negative. Once you get the present, I mean that you take the two. If you add the two, it will give you the present value of cash inflows, which will be a negative. And then you raise present value of cash outflow in year zero, which was 100. And you get NPV. And the NPV will be the same as what you are having here. So once you get that, the NPV, let's go to the second step. You determine the annuity. And in this case, the annuity will be, you take the NPV, you divide by the present value interest factor of an annuity, 11% for 2 years. So our NPV is 261.824. So how do we get the annuity? So to get the annuity is 1 minus 1 plus R raised power negative N over R, because this one is an annuity, and this one will be 261.824 you divide by, so 11%, we are saying that is not in the table. So it's 1.11 raised power negative 2. Then 1 minus the answer, you divide by 0.11. You get 1.7125. 261.824. So here you have 152.89. So that's our annuity. And then the third step, you determine the present value of an annuity until infinity. You get the annuity over the rate. The annuity is 152.89 divided by the rate 0.11. In that case, you'll be having 1389.88. But remember, our cash flows were negative, they are outflows. Lastly, we go to year 3. What if now we replace this machine at the end of year 3? So what will be the effect? So first of all, you get the NPV. So you take the period 0, 1, 2, 3. Then we get the cash flows. Year 1, you are investing 100 million. Sorry, year 0. Then in year 1, you are not replacing, but that means you have to incur the operating and maintenance cost. And the operating and maintenance cost in year 1 is 120,000. Year 2, you are not replacing, but you have to incur that maintenance cost. And the maintenance cost in year 2 is 130. But in year 3, you have to replace. And how much will you fetch from the second-hand market? In this case, the resale value, you get 35. That's an inflow minus the outflow. So how much is the operating cost? in year 3, it's 130. Sorry, 140. So that 5 minus 140, and you'll get 105. It's a negative. So once you get the cash flows, then you will discount present value interest factor, 11% in year N. So that's 1. Year 1 is 0.9009, 0.8264. What about in year 3? So 1.1 raised power negative 3. You'll have 0.7513. And then you get the present value. So that's 100. That one will be 108.108. 105. So this one you get it's 78.89. This one you get is 107.432. But remember, all of them, they were negatives. So we get our NPV. And the NPV you are getting is 394.43. So with that, it's a negative. We go to step number 2. Number 2 was to get the annuity. And to get the annuity, we said you take NPV of a present value interest factor of an annuity, 11% for 3 years. So it will be 394.43. So present value interest factor of an annuity, 11% for 3 years. So it's 1.1 raised power negative 3. 1 minus answer. Then you divide by 0.11. And here you'll get is 2.2608. So here you are getting 174.467. But it's a negative. So that's the annuity. Then the last step, you get the present value of an annuity until infinity. You say in this case, you take annuity over the rate. Our annuity is 174.467 divided by the rate, and the rate is 11%, 0.11. So in this case, you are getting 1586, but a negative. So our optimal replacement cycle. So now we can make a conclusion. Optimal replacement cycle. We see that the optimal replacement cycle is where the NPV is maximum. So on our first step, you look at the present value of an annuity. Assuming this project was to exist to infinity, how much would be the present value? So you compare that. In year 2, you have that, and in year 3, you have that. So between year 1, year 2, year 3, which NPV is maximum? Which NPV is maximum? And in this case, note that we are dealing with the negatives. So the lower the negative value, the higher the NPV. So in this case, the maximum NPV we have, it's in year 1. The present value of an annuity is in year 1. So the optimal replacement cycle is year 1. Now note that if you go back to the question, let's go back to the required. In case you're told that you advise ABC on whether to replace the new machine in 1, 2, or 3 year cycle up to that point, assuming the examiner has not asked about use the equivalent annual cost method, assuming you are not required to do that method. So in this case, what you could have done is just get the NPV for each year. So for the first year, you get the NPV of 136. You ignore the annuity, you ignore the present value of an annuity until infinity. The same with the second year and the third year. And then from there, you make your conclusion based on the NPV. And I think we did a similar question. That was in 2017 in class, but that one does not require this method. So you can take a screenshot.